What is going on, YouTube Nation? This is Darth Dividend. If you guys are new to my YouTube channel, make sure you subscribe and hit the notification bell so you don't miss future videos. So I'm back doing videos. I have been slammed with work. I'm hoping next month it'll be better. And there are some decisions that I need to make with my career. I'm just going to tell you about that. Cross your fingers for me. I'm very excited. But I want to go over something with Realty Income. I think it is a really overhyped dividend stock. Now, don't get me wrong. I own Realty Income. I had this gung-ho mindset, 200 shares, 200 shares, 200 shares, 10K in it, 200 shares, 200 shares, buy the dip, pandemic. But guess what? There's better things out there that if I had 200 shares, I would get a good bang for my buck and possibly, in theory, better in taxes. And of course, this video is not financial advice or tax advice, but I'm going to go to that in a second. But we're going to go over Realty Income and the problems with Realty Income. Now, again, I own Realty Income. I enjoy the passive income Realty Income. It is a really good real estate investment trust. But there are better things out there, and we're going to talk about that. So let's jump to my choice of something better than Realty Income. So let's check out Realty Income first, right now. So right now, Realty Income is sitting at $60.95. This is the monthly dividend REIT. I absolutely love Realty Income. It's a high yield. It has a 5.30% dividend distribution. It is still doing well. And I think pandemic, recession, it's still going to be strong. I'm going to go over a few pros, but I'm going to go over the cons as well. This is something really nice. It has 15,500 commercial properties under long-term net lease agreements. They have very good companies that are paying them rent. They also have a 98.9% occupancy rate right now. There are 92 separate industries. They have 1,700 different clients. They are in the United States and they're in Europe. So that is one thing that's exciting. They have expanded to Europe. That's what makes their portfolio very strong. That's what makes their dividend very strong. That's what makes their funds for operations strong. So again, funds for operations are very good. They have hiked their dividend. They have very good revenue trends. And remember, 90% plus of what they make have to go back to investors. That's the rule of a real estate investment trust. So think about that. Geographically, they are a powerhouse. That's one thing that's exciting about them. I'm going to just go over a few businesses that they are partners with or that are paying them rent. So here's their top 20 clients. 7-Eleven, Dollar General, Walgreens, Family Dollar, Lifetime Fitness, EG Group Limited, B&Q, Wynn Resorts, FedEx, ASDA, Sainsbury's, BJ's, Tesco, Tractor Supply, CVS Pharmacy, Home Depot, MGM Bellagio. Remember, they did that acquisition. LA Fitness, again, and Walmart, Sam's Club. So they do have a very good portfolio. Those are their top 20, and they also have other ones. These are really good businesses that probably aren't going to close their stores. Now, Walgreens did take a hit with their dividend, and there is a lot of competition with the pharmacies. So maybe they may go bad, but guess what? They have other tenants that will cover things. Dollar General is always big. Family Dollar is always, they're always busy. 7-Eleven's always busy. So these are people paying them rent. Remember, funds for operation are very important to look at. They have strong funds for operation. Now I'm going to jump to their dividend history. So the good thing is, I'll start in 2022. 25-cent distribution, 2023 26-cent distribution, and then we have a 27 distribution, 27 cents in 2025. So it's not bad, and the dividend growth in 5 years is only 2.98%. So again, the number of dividend increases in the last 5 years is 24. Remember, you're going to get a higher payout ratio with REITs, and you have 5.32% dividend yield, which is good. So if you bought one share, you made 324. So again, we're looking at 27 cents. Okay, so right there, again, monthly distribution, that's nice. But this is what I put my money in at one point, and I would favor this other high yield ETF by the NEOS that I like better for long-term distribution. Good luck with the dividend growth of Realty Income to catch up with this. I'm going to jump to this. And I prefer the NEOS Real Estate High Income ETF over Realty Income right now. And again, it's in the negative in the past 5 years. It's sitting at 46.89. But the NEOS Real Estate High Income ETF has a bigger bang for your buck than Realty Income. That if I had 200 shares of, and I had a choice between Realty Income or IYRI, I'm going to tell you IYRI, and I'm going to explain to you why. And this is why I've been buying it as well. So you have a monthly distribution. The management fee is 0.68%. The distribution rate is 10.92%. Wait a second, there's a management fee? That's fine. Okay, this is why. The fund seeks to distribute high levels of monthly income through a data-driven call option strategy on ETFs that seek to track the Dow Jones Real Estate Capped Index. Okay, so it's actively managed by NEOS. It seeks to offer upside potential in addition to primary objective of high monthly income. The fund may offer efficient exposure to a portfolio of the U.S. listed REITs with an enhanced layer of high monthly income potential packaged into a single ETF. Right here is the nice thing. Distributions made by the fund may have been classified as a return of capital and may have been compromised of option premiums, dividends, capital gains, interest payments, and of most recent distribution by the fund, 99% was estimated to be return of capital. Please see the 19A-1 notices for more comprehensive breakdown. So that's one thing to really look at is the return of capital. The most recent distribution was 99% was the return of capital. So you have to do some digging. I'm not going to go in depth. I'm not giving tax advice, but this is one thing that captured my mindset when it comes to this. Because remember, and you can correct me if I'm wrong, if I made $500 a month in dividends with Realty Income with a dividend portfolio, I have to report that as $500. You just saw the most recent distribution of the fund was 99% estimated to be return of capital. Think about that long-term wise. And I'm going to just go over this on the NEOS website. What is return of capital in an ETF? Return of capital is a distribution made by the ETF to its investors that is classified as a return of the investor's original investment. Unlike dividends or interest income, return of capital is not considered income and is not immediately taxable. Instead, it reduces the investor's cost basis in the ETF and can be particularly useful in an ETFs that use option writing strategies to consider income. Again, what factors might investors want to consider? This is on their website. Return of capital can help lower an investor's current tax liability. By reducing the amount of taxable income an investor receives, return of capital can potentially reduce the amount of taxes owed in the year the distribution is received. This may be especially favorable to investors for high tax brackets. Return of capital can help investors manage their cash flow needs without requiring to sell assets. This can be particularly useful for retirees or others who rely on investment income with their living expenses. Now, don't get me wrong. I own both. I absolutely love both, but this is one thing that I like about the IYRI ETF. I'm going to go further into this. And on their website, they show you each one, how it is kind of reported. And here's the distribution history right now. So you're in the 40s versus 27 cents. The other thing is right here, the holdings. Welltower, Prologis, Simon Property Group, American Tower. Wow, Realty Income's in there. That's going to help the NAV. Ventas, Public Storage. I own some of these, okay? The nice thing is their NAV has done very well. That's going to help with the share price of the NEOS ETFs. And guess what? When it goes up, hopefully there will be hikes with the distribution. So I wanted to point this out that I have been evolving my high yield dividend investing strategy. And I like IYRA long-term wise. Yes, there is a high expense ratio, but guess what? I'm getting a better bang for my buck with IYRI ETF. Yes, I will be buying shares. My dividends will be buying shares of Realty Income. But long-term wise, I would like to retire on income like IYRI versus REITs. So that's one thing that I thought about and evolved my dividend strategy with. So if you're new to this YouTube channel, make sure you subscribe and hit the notification bell so you don't miss future videos. Again, I have a disclaimer in the beginning about this video is not financial advice and it should not be taken as tax advice either. Take care and have a great Saturday.